Hi everyone, I'm Mark Lichtenfeld, Chief Income Strategist with the Oxford Club. Welcome to State of the Market, and be sure to subscribe so you never miss another State of the Market video. Now, as you probably know, I'm the income guy. It says so right in my title, Chief Income Strategist. And my goal for myself and for my subscribers is to help generate passive income. You know, the kind of income that just shows up in your account or your mailbox. I'm talking about things like dividends and royalties and rents. And one way to do that is through real estate. It's an excellent way to generate passive income. Now, sure, you have to put down a deposit and maybe fix up the place, pay the mortgage, but those rents that you collect every month should generate cash flow. Now, I realize not everybody has the money to put down on a property, and then you also have to manage tenants, and who really wants to deal with that? It can be a nightmare. For example, this is what my property looked like 2 years after one tenant moved in who was a 32-year-old nurse. Can you imagine being in her unit at the hospital? Ugh. One way to receive passive income from real estate investing without dealing with disgusting tenants is by owning real estate investment trusts, or REITs. Now, these are companies that own real estate, collect rents, and pass along their profits to shareholders in the form of dividends. In fact, by law, REITs are required to pay 90% of their net income to shareholders. And as a result, many REITs have fairly high yields. So let's take a look at the 3 highest yielding REITs in the market today. All right, the first one is Presidio Property Trust, ticker symbol SQFT, like square foot. Get it? Anyway, the stock pays a really high dividend, 10.2 cents per share each quarter, which comes out to an 11.6% yield for this very low price stock. Presidio Property Trust describes itself as a contrarian real estate investor that focuses on out-of-the-mainstream properties. It owns 9 individual houses in states like Texas, Illinois, Florida, and Wisconsin, and 14 commercial properties in California, Colorado, and North Dakota. Now, the company pays a great yield, but I'm not so sure it'll be able to keep it up. Here's why. Last year, funds from operations, or FFO, which is a measure of cash flow that we use to analyze REITs, FFO was 16 cents per share, nowhere close to the current dividend of 41 cents. In the first quarter of this year, FFO was 9.8 cents per share, almost enough to cover the 10.2 cents it paid out in the first quarter. Now, it's only been a publicly traded company since October 2020, and last year, rental income was down 15%, although granted, 2020 was a very difficult year for commercial property owners. Now, the first quarter did seem much stronger. If it can continue to improve and get FFO above the current dividend, then it could be an interesting high-yield play here. But that's a very big if for an unproven company, especially in an age where we don't yet know if workers are going to be returning to the office or how many of those workers will return. So there's a lot of unknowns here. All right, let's move on to the second stock, and that is American Finance Trust, ticker symbol AFIN, another low-priced REIT, and it has a yield of 9.2%. It trades below $10 currently. It focuses on service and retail-oriented tenants like Walgreens, Chili's, AutoZone. It has 925 properties that are 95% occupied with an average remaining lease of nearly 9 years. And it received 99% of the rent due in the first quarter. Those are some very impressive numbers. FFO was 90 cents a share in 2020, down slightly from 93 cents the year before. In the first quarter of this year, FFO was 21 cents a share. Last year, it paid out just 70 cents a share in dividends. So that's well below the funds from operations. So it easily was able to afford those dividends. This year, it's paid out 21.25 cents in the first quarter, just a fraction above FFO for the first quarter. For the full year, it's projected to generate 95 cents a share in FFO. So the stats look pretty solid. You just have to be comfortable owning commercial and retail space in the current environment. But as long as its largest tenants like drug giant Sanofi or banking giant Truist or Stop and Shop continue to pay the rent, then you should be okay here. An American Finance Trust could be a really interesting high yield play here. Okay, our third and final stock we're going to talk about today is Global Net Lease, ticker symbol GNL. This is the third highest yielding REIT in the market today, yielding 8.3%. It owns 306 commercial properties in the United States and Europe. So it's a nice way to diversify outside of the United States. Its top tenants include FedEx, Whirlpool, and the United States government. Now, Global Net Lease slashed the dividend in 2019 and it cut it again in 2020. In 2020, FFO was $1.51 per share, and that's well below the $1.7325 paid out to shareholders last year. In the first quarter of 2021, FFO did improve to 42 cents a share, which was above the 40 cents per share dividend. Now, I don't love this one based on its dividend history. It may generate enough FFO this year to cover the dividend, but considering it's cut the dividend not once, but twice in the last 2 years, as George W. Bush once famously said,
"Fool me once, shame on you. You fool me, we can't get fooled again."
So there you have the three highest yielding REITs in the market. Let me know what you think about real estate investing, and if you've been a landlord and have any tenant horror stories you want to share, feel free to leave those in the comments section below. After all, misery loves company. And for more wealth and income building ideas throughout the week, be sure to check out my free e-letter, Wealthy Retirement. Just click on the link below. I'm Mark Lichtenfeld. Thanks for watching State of the Market. I'll see you next week.